All right, guys, here we go again. Our 10-year anniversary of our real estate market forecast. Chris has done, I think, 8 of those years. Just wrapped up your keynote. Fantastic job again. So, first of all, let's go back. It was a year ago to this week.
Yeah.
We got the phone call from the Fox Theater. Fox Theater says, we're sorry, no live events.
Yeah.
We basically were in this studio. You did your thing with Manford, Kyle, a few others. I don't think any of us, I certainly didn't think we'd be doing an in-studio event and no live events and just now maybe getting back into dining a year later. But you called the V. Generally, I don't want to say you were optimistic, but your analysis of the data was, hey, the fundamentals are there. Everybody's kind of relax. We'll get through this. I think it's taken a little bit longer to get through it, but generally speaking from a real estate perspective, real estate industry record-breaking years last year.
Yeah.
Where did you? I don't remember you saying we were going to have a record-breaking year.
Well, yeah. Look. There's a couple things. Let's go back to last year, right? So again, using the metaphor of a natural disaster, this thing's going to come back quicker. Fundamentals of the economy, this thing's going to come back quicker than the vast majority of people. And that was most of my message. Now, where did I go wrong last year? I think twofold. First place is I didn't anticipate, like you said, that here we are a year later and we're still in the studio. I was hopeful we would get control over it earlier than that. I was overly optimistic on that. This thing came back in a big way at the end of last year. Worst surge to date, more deaths than the first 2 surges together by far. The epidemiologists were dead on right. They said winter's going to be ugly, and they were so right. So that one, yeah, I missed, no doubt about it. But what's interesting is going back to my idea about mitigation, about people learning to live even in the presence of COVID. Think about how well the real estate market did. Think how well the economy did, even in the face of that mess at the end of last year. It gives you some sense of that my confidence, I think, in the overall situation was quite right. Now, the other thing I didn't really anticipate was $5 trillion of stimulus.
Right.
I didn't anticipate $3 trillion of quantitative
Was that
easing.
even being discussed in March? I mean, I know
the federal government was starting the fiscal conversations, but we weren't sure what form it was going to take.
Right. But we were so early.
Yeah.
Again, I don't want to revise history, but
Yeah.
we were so early, middle of March of 20. Okay, so we hadn't really gotten to the point where PPP and all the rest of this sort of stuff.
Don't forget, we didn't even know how bad it was in March and April until the data started coming out in April and May. So in that sense, it was a little bit later than that. But again, when you think about the amount of money they poured in an economy that really didn't need it, that gave, again, a boost to the economy, including real estate. I mean, think of all these people still working their jobs, making good money, a lot of them getting raises. They can't spend anything. The money's piling up. The bank gives them another check. The government gives them another check. And then, interest rates, I mean, they were sub-3 for a long
3%.
time.
Right.
All that added together just put a fire on real estate. The ferocity of that bounce back caught me off guard. No doubt about it. I expected it to bounce back, but not like that.
Right. Well, and again, obviously, we're not talking the restaurant business. We're not talking entertainment, travel, whatever it happens to be. But so we sat here, again, March of 2020. If I'm being honest, when we were shooting that video, I was privately having a panic attack.
Yeah.
Just from a real estate, running my business. Oh my God, what does this mean? I mean, we're locked down. We can't go anywhere. It's so funny how we've almost become accustomed to walking around with masks and eating outside or Uber Eats or whatever it happens to be. But back then it was like, oh shit, this is a problem.
The real deal, yeah.
And then at least and I would think most real estate agents or broker owners like myself probably had a realization very early on. I'm talking like maybe 3 weeks in, first week of April. Certainly by April 15th, we're like, okay, this is interesting. The buyer demand seemed to be fine. We can talk about inventory and sellers here in a little bit because that's a problem for us right now. This lack of inventory, lack of housing from a purchase standpoint is insane. But the buyer demand, which is still to this day, I'm still confused. If it's interest rates, great. But I just ultimately say the buyers that were out there obviously had no concern over their job stability. Yeah. And interest rates were great. Maybe they did the math and said, hey, let's buy. Maybe they're working at home, all the rest of that. But I still can't quite put my finger on why
Well, okay, couple
residential
things
real
here.
estate was so good.
Yeah, well, here's my sort of back of the envelope explanation for this, and it has a lot to do with two things. One is the friction that the pandemic put into the market, and what I mean by that is, typically people buy and sell at the same time. Not in a pandemic. In a pandemic, I'm not selling my house till I have another house to move to.
Okay, which is a problem right now, I think.
Yeah, and that's so what that did. Remember, this was already a tight market, and then you add that little friction in there, and it becomes that much tighter. Right. And then you have the human psychology, because when one person started to want to go out and get a house, and then somebody else did, and somebody else did, there's not a lot of inventory. Suddenly, bidding wars are picking up, and people get panicked. People get, I want to do this. I got to get this done. And people get more and more ferocious in activity, and people then start seeing lines. They see prices go up. I got to get in now too.
Right.
And the psychology of a hot market brings more people into it. It snowballs, if you will.
Right.
So I think the frictions and the snowball is what caused this market to go into this red hot flame. Now the real question coming into, say, the second half of 2021 is how much momentum does this have? For example, you get rid of the friction, interest rates are starting to drift up a bit. Will this cool off, or will the psychology of the market keep it going?
Right.
There's a big question there. My intuition says this market has momentum.
Right.
And it's going to be hot for a while.
It feels that way, and it's funny, you had said something just 2 minutes ago, and I've already forgot the exact quote, but the gist of it was, I was saying something in late March or April, we were feeling good. You said the data came out in April or May, or you're the economist. Right. You're always looking back. At least in our world, I mean, I'm in it. I mean, I don't have to look. I mean, I'm like, shit, what's going on right now? Well, what's going on right now is a ridiculously hot March with one problem from a buyer perspective. The demand is crazy. I hate the fourth quarter of every year. But by the way, we generally have good fourth quarters, but I don't like the fourth quarter. Okay, we traditionally slow down. The first quarter is always a little slower, and then for years we have traditionally had a hot real estate market. If we have a good market, which we have, that is it starts to build in March, and then April, May, June, July, and it used to go through August and September. It seems like, at least in my world, that season seems to be.
Well, you get to Thanksgiving, you get to Christmas, people want to be home, they're not thinking about moving, and the market starts to cool off.
True, but it seems like that's even been coming sooner. Yeah. It's like, it wasn't a Thanksgiving thing, it was like an October thing, and it was a September thing.
It's kind of like Christmas stuff at Costco.
Well, then you start looking even at some of the Augusts over the last few years. That was good. Our audience is laughing. So, but my point being is we just searched. There was, in my mind, really no fourth quarter, a traditional real estate cycle in the fourth quarter. October, November, and December were frankly just as strong as May, June, and July. Now, I believe we would be having record-breaking January, February, March, but because the buyer demand is there.
Yeah, but that goes back to, again, and it's funny because remember that at the beginning of last year, I was on a little bit of a victory tour. Because at the beginning of 2019, 80% of economists contributed that Wall Street Journal next recession, so we're going to have a recession by the end of 2020. Right. Nothing to do with the pandemic.
You took that slide out, by the way. You took out this, every 2 years, there's a recession forever.
Exactly. So they were talking about other things now, right? You got to move on.
Right.
But to your point, by the beginning of 2020, that had dropped to like 9%, right? And what they were talking about was, rising interest rates, a collapsing real estate market, the Chinese trade war is going to push the U.S. economy into a recession. A preposterous degree of hand-wringing. Right. Over nothing. And again, the fundamentals that had slowed the market down had started to kind of fade away by the end of 2019. I'm not surprised. You already started to see that little bit of a bounce in the market returning to what I would call normal, because it had been soft in the year ahead of that.
Right.
Now, California in particular, remember, the economy out here has been good. We've had incredibly tight labor markets. There's just not enough housing, period.
Right.
Period.
It's horrible.
Yeah.
I mean, if a couple other speakers earlier, and by the way, I have no idea what order things are going to appear. Generally, you're last, so you're kind of keynoting at the end. This interview would come at the end. If we mix things up a little bit, you might have to go back and watch somebody else. But earlier, one of the other interviews we were doing, we were talking, if you were a builder. I mean, gosh, if we were building, and we knew, I mean, my God, if the builders had tens of thousands of units in Southern California right now, or for that matter anywhere, I suppose, in California, or at least in these tight markets, everything would be sold. I mean, who would know that we have 70 houses for sale in the city of Moreno Valley. 70. compared to what? We were complaining 2 years ago when we had 350. 10 years ago, we had 1,500 houses for sale, and that was normal.
Yeah.
Okay, so the inventory levels are so low. Again, the builders that have inventory, I mean, gosh dang, they're happy as pig in mud.
Yeah.
But what changes the inventory? What changes? What gets the seller to the
Everything
market?
is so hard to do in this state all the time. You
Right.
know, you have local governments that resist you. You have the state, all sorts of regulations. You've got all sorts of issues with the unions and everything else. And you have basic zoning constraints, and it has just created a situation by which nothing gets done in any efficient way. And California needs to do something about it. You
Right.
know, they've been nibbling around the edges. Again, the public world is all focused on inequality, on
Equity.
poverty. And their focus is on affordable housing, affordable housing, affordable housing. And it's backwards. If you focus on affordability, you're missing the point. The lack of affordability is driven by the lack of supply. You fix supply to fix affordability.
Right.
The things they do to tackle affordability, such as inclusionary housing mandates, rent control, that hurts supply. And you ultimately end up chasing your own tail. It is, and listen, I appreciate their concerns. Obviously, as a society, we should be working to help those less fortunate to get a leg up in the world. But when it's your only conversation, when it's your only focus, you end up, I think, ultimately doing more harm than good.
Right.
Because these people, a lot of these folks are having to move right out of the state. Again, how many years in a row have we seen record exodus of people just leaving the state of California?
And that
They're
continues.
moving to Nevada, they're moving to Arizona, they're moving to Idaho,
Texas, yeah.
Texas, because you can't afford to live here.
Okay, so if I'm a tenant, oh my gosh, the appreciation or the inflation of rents. I mean, good Lord. I mean, you called this a year or two ago, and we had this conversation privately, and you're like, man, there's going to be a lot of upward pressure on rents. Man, is there a lot of upward pressure on rents? So, getting back, I want to segue real quickly to on the rental side, the eviction stuff. All right, you had mentioned in your presentation, wrong. You believe the people are wrong. Oh, we're going to have waves of evictions and waves of foreclosure
Based on nothing.
Based
on absolutely nothing.
Right.
There's
Okay.
no historical evidence that that was going to occur, not a shredded data that was going to suggest that was going to occur.
Right.
But again, it feeds a narrative. It's a narrative that they embrace.
Right.
Because again, it's all about the equity, right? It's not about the whole; it's about the equity.
Okay, so let me speak directly to the audience for a second, because a lot of our audience, I get this all the time. Oh, we're going to have loads of evictions, we're going to have loads of foreclosures, and I just don't see it. I don't see it. Chris, we got a couple other speakers we still have yet to record, but we've had 4 other speakers. You will all see them. Everybody basically says the same thing. And at least in our world, Inland Empire, on the eviction side or on the rental side, our performance of our tenants is as good, if not better, than it was pre-COVID.
Well, that's because they can't spend money on things. They have money left over to pay the rent.
And you touched briefly on the forbearance. So you've got X amount of, the prior speaker said there's Freddie Mac, Fannie Mae, so there's 2.6 million properties in forbearance.
But we don't know what that means.
Well, let's suppose it means there's 2.6 million properties. Let's just stipulate we saw a 20% increase in property values.
But those properties all getting increased equity.
That's what I'm
They're not
saying.
gonna
They
get
all have
foreclosed on.
equity.
It doesn't matter.
So what does it mean? So it's like,
Doesn't mean
well, I'm
anything.
still in trouble. So I come out of COVID. I happen to be a homeowner who's been negatively impacted. I mean, we're over here puppy dogs and rainbows, and oh my gosh, thank God we're in the real estate business.
Yeah.
But if I'm happen to be in one of those industries who's not, and I've gone through a forbearance, well, if when I come out of that, whenever that may be, this year I suppose maybe, if things still don't look good, I've got equity. Right?
Lots of it.
Right, lots of equity. So if I have to sell, I sell. I put some money in the bank.
You sell it, you pay off your debts, and you got some money left over.
And we regroup. Okay, so we can put that off the table. So we all agree we're not going to have
no
that sort of an issue.
foreclosures, no major evictions.
Now, a couple of the other speakers were talking, and it seems like this is possible, but I can't see this making any impact on a large measure. A lot of landlords, single-family folks, maybe not necessarily more professional landlords with multiple units, are saying, you know what, I've had enough of this. I've had enough of this being a landlord in California, especially if you're a landlord who hasn't received rent in 9 months, and maybe you're going to pick up 80%, whatever the formula is for the rent credit from the government, whatever it happens to be. But we had an eviction attorney, the number one eviction attorney, in my opinion, in Southern California, sitting right here 3 hours ago, that he says he's getting phone calls, 4, 5, 6, 8, 10, 30 phone calls a day, and 5 of those a day are landlords that says, I got to get out of here. I want to sell. Can I evict? And that's a whole different conversation. Watch Barry O'Connor's interview. So I'm like, oh, okay, well, I wonder if that really is going to translate. When we come out of this, are there going to be some landlords that say, get me out of here, get me out of California? Now, he didn't like it because he likes rental stock and he wants to deal with the eviction side. I'm like, give it to me. You know, if we turn, just like the hedge funds who bought and held, okay, that was nice. Well, if you're on the sales side, we like to loosen that inventory up and put it back into resale. So, but if that happens, it seems like it's a small percentage. And then the same thing on the forbearance side, another individual said, well, hey, well, maybe we get some people some that are coming out of forbearance. Yeah. But it seems like, if anything, that would be a super small percentage.
And not only that, but let's go to the next step, because yeah, I've heard of that. In fact, I've known major apartment investors who have kind of pulled up and said, okay, California is just too complicated. Right. I don't want to be here anymore, and they're investing in other places. And one of the things they've all said to me is, yeah, I sold my stuff, and it was remarkably easy.
Okay.
Everything I sold got snapped up immediately at a price I didn't even anticipate. And candidly, rents are still rising in California.
Well, but that's the reason why you can't do that.
Yeah.
So I would turn to our landlords. We've got a lot of landlords through our Cobalt Property Management Division watching right now. And if they're having that thought, I'd say, oh, yeah, sure, if you want to sell, great, call us. We'd love to sell it. Sure. But at the same time, I'm like, relax. Okay. Rents are going up. You know, why would
well, in this supply-constrained world, it's not like you have to worry about too much supply, unlike, say, a place like Phoenix. I mean, Phoenix is growing gangbusters, but then Phoenix has also a huge amount of new housing coming online. Right. At some level, they could get oversupplied. It could make it a less desirable location later on, where you don't have to worry about the supply coming online here in California. It's kind of the offset, as the case may be. Now, mind you, don't get me wrong. I like a lot of folks, and I will say I've been a bit of an apologist for Sacramento. You know, I always say that, yes, we're a business-unfriendly state, but the upside is such that it hasn't mattered. The state continues to be an economic success story. But they seem to be so tone-deaf at this point in time. They seem to be so concerned about social justice as opposed to governing the state appropriately. Right. Will they go too far? I don't know. I appreciate people's worries. We need elected leaders who have their feet on the ground and are paying attention to reality. And that's not this world right now.
Right.
And it's scary.
Right. It's crazy.
But then again, is it that much better in other places? Right? I mean, there's lots of that go floating around the United States right now.
Right. Yeah. Okay, I don't want our wrap up to go longer than your keynote. So 2 quick things. Let's just put a button on interest rates. We've ticked back. We were in what? We were sub 3, mid 2s. Now, as again, 24th, let's say, of March, even though we're pre-recording this, so we're a few days early. We're in the low 3s. Any idea where we're going to be at the end of the year rates?
I think rates are going to continue to drift up. Like 10-year bond rates are coming up. Yep. You're talking about again that return to normalcy. Right. The federal government's going to be absorbing a lot of free cash out there. $4 trillion in issuances this year. Okay. That all suggests interest rates are going to continue to go up. Now, you know, what do we come into this at? You could probably get, you know, a mortgage in the 4% range coming into this.
I think a year ago around 4.
I anticipate by next year we'll probably be back to that 4% range.
So
now the question is what happens beyond that. Then that, of course, has a lot to do with inflation. And the federal government and everything else. But I would argue that you know, if they don't do much, heat up inflation, you could get back to 6 or 7% mortgage rates in 5 to 6 years.
Oh,
yeah,
well, there you go. There's the quote.
Is it possible?
There's the 6er. Yeah. Okay, I've been talking about this in my meetings. Wow, now we're going to have to go an extra couple minutes. Yeah. When I don't know when it was, we could go back and figure it out, but there was a time when things were difficult, and I believe NAR and CAR, if we could just get rates to 5 or 4.5. So obviously we're probably talking 7, 8 years ago. I don't know what it was. And I could just remember, oh, great. Well, then guess what? Lo and behold, things got to sub 5. Yeah. And then we've continued to drift down. My gosh, I panic in my office. I said, but I don't panic because, I mean, are you kidding me? Well, wait. So a 4% interest rate, a 5% interest rate, come on, it's still ridiculously cheap money. Even a 6% interest rate.
It's not bad.
It's ridiculously cheap money, but I worry about the mindset.
Yeah.
I worry about the mindset of the consumer that sits back and says, wow, what does that do? I don't know what that does for
but
the real
that's
estate
very
market.
similar to what we saw in 2019 in the markets, because rates did go up and there was a reset. That's how it works, right? The market has to reset a bit. You know, I like to think of it that there's a fundamental value of a house, right? And that fundamental value is driven by the value of you living in it, the rental value, if you will. But then the cost of that is driven by, of course, the interest rates, what you paid for it and everything else. There's some equilibrium factor there. Now, if you push interest rates up, that makes it more expensive. And that means the price has to come down a bit to kind of re-equilibrate. Now, home prices don't fall, right? They're very sticky on the way down, unless there's really extreme circumstances in the market. So the real result is price growth flattens out and you see a decline in sales until the fundamentals catch up with that market level, and then things start moving forward again, which is what began to happen at the end of 2019, which is you were talking about a little earlier. So that's a very similar type of circumstance. It's not the end of the world for the market to have prices go up that high. However, it will cause, obviously, the market to slow down. Now, the question is could it go even beyond that? I mean, how much inflation will they tolerate? And more specifically, when people start spending and borrowing again, and you add that in with this massive amount of federal borrowing, could there actually be a shortage of cash? That, I think, is not much of a possibility. There's still lots of money floating around the global economy. I'm not worried about that. But the inflation question is the real deal. And, you know, again, inflation, real estate's a good hedge for inflation at one level. But, of course, the bond markets freak out because of inflation because they can't gauge the returns. And next thing you know, all hell breaks loose.
So I think we're going to end on a really high note,
right?
Because you threw the inflation thing out there. You got some concerns. I believe you said, as an economist, it's one of the most difficult things for you to kind of put your finger on.
Yeah.
But if I heard you correctly, puppy dogs and rainbows in 2021,
2022,
2022,
probably even 2023.
Oh my God, 2023. So I mean, it's a really positive.
Yes, absolutely. And this is what I've been. I didn't actually have my talk today on that, but this is what I've been telling all my folks lately. Look, this is the next 2-3 years are going to be great.
Right. In spite of the miserableism.
Exactly.
Right.
Enjoy the party. Just get out before the cops show up. Because again, there is a downside. There is something's going to happen out there, and the point here, where people get themselves into trouble, is when they overextend. Keep an eye out. Understand there are risks. Make it when you can, but be ready to get off.
Okay. So if I'm hearing you right, we're at the party.
Yeah.
It's 8 o'clock. And we got the cops normally show up around midnight, 1 o'clock.
1 o'clock.
1 o'clock.
Depends how grumpy
so
your
we
neighbor
got to
is.
figure out exactly when 1 o'clock is.
Yeah.
But it sounds like it's at least a couple years out.
A few years out.
Wow. Well, there you go. So that's the takeaway. So anyway, Chris, I think this is year 8. Thank you. You certainly will be back next year. And thanks for everything, man.
Great to be here.
The COVID bump. All right. That wraps our 2021 real estate market forecast. Thank you guys for participating. Everything you've seen is going to be available on our YouTube channel, social media, et cetera, et cetera. So if you missed anything, you'll have plenty of opportunities to re-see it or rewatch it. Have a great day. Thanks.